Chapter 1, Taxation Framework. Insurance agents should have a basic knowledge of the Canadian tax system to better serve their clients. However, it is essential that agents recognize that this chapter will not make them an authority on all matters pertaining to tax. At times, they will need to call on the expertise of an accountant to better serve their clients. 1.1. Taxation and the practice of life insurance agents. In Canada, taxes are mandatory and levied on individuals, trusts and corporations by 3 levels of government: federal, provincial, and municipal. Governments use tax revenue to pay for such things as old age security, OAS, on the federal level, healthcare and education on the provincial level, and police and fire departments on the municipal level. 1.2. Canadian tax system. Federal and provincial governments collect income taxes and also raise money through what are collectively known as commodity taxes. These will each be addressed below. Personal income tax. Personal income tax is the tax levied on the total income of individuals net of deductions and credits. It is based on an individual's taxable income. Taxable income includes salaries and wages, commissions, rental income, net income from unincorporated businesses, for example, self-employment income, investment returns such as interest, dividends and capital gains, and certain benefits. Federal income taxes. Federal income taxes are based on graduated tax rates. This means that the percentage of taxes paid increases as taxable income increases. Thus, an individual with a higher income will have a higher tax rate than an individual with a lower income. Currently, the top federal tax rate is 29%. Corporations pay either an 11% or 15% federal tax rate. With the exception of Quebec, which has a separate provincial tax return, the federal tax return for residents of the other provinces and territories include provincial and territorial returns. The main criteria for filing a return are: does the individual owe unpaid taxes? Is the individual required to contribute to the Canada Pension Plan, CPP? Does the individual have taxable capital gains? For 2016 federal tax rates, see Table 1.1. See example in Section 1.2 on how to calculate federal tax. Provincial income taxes. Individuals also have to pay provincial income taxes. The criteria may vary from province to province, but generally they are asked to provide information from their federal returns including taxable income, net income, dividend income, Canada Pension Plan, CPP, and Quebec Pension Plan, UPP, contributions, employment insurance, EI, premiums, medical expenses, and donations and gifts. The provincial forms are included with the general income tax and benefit package, except for Quebec, who has its own. Provincial income tax rates vary from province to province. The provinces have also graduated tax rates for individuals, with the exception of Alberta. Alberta has a flat rate system of a 10% tax rate on taxable income. For 2016 provincial tax rates, see Table 1.2. Commodity taxes. Commodity taxes include GST, Goods and Services Tax, PST, Provincial Sales Tax, and in provinces which combine the two, the HST, Harmonized Sales Tax. HST is not charged on all purchases. Items as basic foods, prescription drugs, and insurance premiums are exempt from HST. HST combines GST and PST, and only exists in some provinces. In Quebec, the Quebec Sales Tax, QST, follows the same rules as GST. The QST is not harmonized and is a separate tax. Excise taxes are charged on such things as alcohol, tobacco, and gasoline. Up-to-date information on GST, HST, and PST can be found on the Canada Revenue Agency, CRA, website. While insurance premiums are exempt from HST, some provinces can charge a premium tax on certain types of insurance including group insurance. These will be covered in Chapter 3. Withholding taxes. Withholding taxes are prepayment of taxes owing. Domestic withholding tax. When an employee earns a salary, the employer typically withholds a portion of taxes the employee would normally owe, and submits that amount to the government on behalf of the employee. Withholding taxes also apply to items such as RRSP withdrawals. 10%, 5% for Quebec, on withdrawals $5,000 or less. 20%, 10% for Quebec, on withdrawals from $5,001 to $15,000. 30%, 15% for Quebec, on withdrawals greater than $15,000. In Quebec, there is an additional 16% that will be withheld by financial institutions and insurance companies. Example. Jean-Marc, a resident from Quebec, withdrew $20,000 from his RRSP based on the amount he withdrew from his RRSP. The 15% rate for Quebec would apply, so the tax would withhold 15% of $20,000 or equals $3,000. Therefore, Jean-Marc will receive $20,000 minus $3,000 or $17,000. According to Jean-Marc's overall income, if the amount withheld is too high or low, any amount will be determined when he files his tax return that year. Foreign withholding tax. Individuals may be subject to foreign withholding tax if they receive dividends from shares of foreign corporations. As a result of treaties, most countries waive or significantly reduce the withholding tax paid on income earned on assets held within registered savings or income plans, that is, RRSPs, RIFs. There is no mechanism for the refund of withholding taxes pertaining to dividends on foreign securities held in a tax-free savings account, TFSA. Example. Chris owns shares in several U.S. dividend-paying companies. He knows that there will be a default withholding tax rate of 30%. If he files the right form, he will be eligible for a preferential rate of 15%. He may minimize the Canadian taxes otherwise owing on this U.S. dividend income by claiming a foreign tax credit when he files his Canadian tax return. Withholding taxes on assets owned by non-residents. Administered on assets owned by non-residents or payments received by non-resident. Includes items such as annuity payments and insurance policies. 1.3. Definition of a self-assessed tax system. Canada has a self-assessed tax system. Canadians report their own income and file their own taxes accordingly. A self-assessed system doesn't mean that income tax payment is optional, but that individuals are the ones filling their tax returns, not the government. Any taxes owing are due by the tax return filing deadline date. As such, taxpayers should send payment for any taxes owing to Canada Revenue Agency, CRA, when filing their tax return. Within a couple of weeks of filing, a notice of assessment is sent to the taxpayer confirming either an amount owing or a refund. If there is a refund owing by the CRA, payment will be made either by check or a direct deposit to the taxpayer's account. The Canada Revenue Agency, CRA, regularly audits or inspects a number of individual and corporate tax returns in order to verify legitimacy. Some audits or inspections are performed at random, others may be due to a suspicious or excessive claim. The CR can audit up to 3 years after the notice of assessment is sent. Corporations other than Canadian-controlled private corporations and mutual fund trusts up to 4 years. No time limit for fraud and a blatant disregard of tax rules. Individuals are required to retain all tax-related information for 6 years. For example, an individual who files taxes in 2015 should retain those records until at least 2021, in case he or she is audited in a subsequent year. Canada Revenue Agency, CRA, audits. Each year the Canada Revenue Agency, CRA, audits or inspects a number of individual and corporate income tax returns, HST, GST returns as well as excise tax, duties and payroll records. Most taxpayers earn salaries, wages or are pensioners. Their incomes are easily verified by comparing the information they file with the CRA with the information employers and financial institutions provide. Taxpayers who are in compliance should not be concerned about such reviews. The CRA will generally take more care to review individuals who have business or professional income, as well as corporations and trusts. Levels of Canada Revenue Agency audit. According to the Canadian Revenue Agency, CRA, there are 4 ways of selecting files for audit. Computer-generated lists. Most returns are selected for audit reviews from computer-generated lists. Audit projects. In some cases, the CR tests the compliance of a particular group of clients. Leads. They include information from other audits or investigations, as well as information from outside sources. Secondary files. Sometimes the CR selects files for audit because of their association with other previously selected files. If the CR selects a return for an auditor will review the individuals, corporations or trusts return information the CRA has on file, such as the taxpayer's returns and financial statements, and it may request specific records from the individual. When the CR completes the audit, the auditor will issue a notice of assessment or reassessment if there are adjustments to the return. If a taxpayer disagrees with the notice of a reassessment, they can try to resolve the issues that led to a reassessment at a CR Tax Services Office. If the taxpayer has no success at the Tax Services Office level, a notice of objection can be prepared. This will lead to a review by the CRA's Appeals Office. Beyond that, appeal may be made to the courts. Statutory limits on audits. The normal reassessment period for most taxpayers is 3 years after the CR sends its notice of assessment. The exceptions are mutual fund trusts and corporations other than Canadian-controlled private corporations, for which the normal assessment period is 4 years. After this period, the CRA is barred from commencing an audit. Similarly, a taxpayer cannot ask to have a file reopened to claim a refund. In the event of fraud, gross negligence, or a conscious disregard of tax rules, there is no time limit. Retention of records. The Income Tax Act requires that taxpayers keep all records to verify information contained in filed tax returns for a period of 6 years from the end of the taxation year relating to the records. 1.4. General Anti-Avoidance Rule, GAAR. GAAR is intended to prevent individuals and corporations from engaging in transactions that have no other purpose than to provide an inappropriate tax benefit. The CR definition of tax benefit under the Income Tax Act is a reduction, avoidance, or deferral of tax or other amount payable under this Act, or an increase in a refund of tax or other amount under this Act. The CR discourages and prevents excessive tax avoidance through several strategies. Regular reviews for potential tax avoidance issues. Monitoring current tax avoidance trends such as tax shelters, and new legislation from the Department of Finance aimed at preventing tax evasion and excessive tax avoidance. For more information on tax avoidance, consult the page, Tax Avoidance, on the CR website. 1.5. Filing tax returns. Both individuals and corporations must file taxes before the respective deadlines. Individuals who are U.S. citizens or hold a green card also must file a U.S. tax return. Fiscal year and tax reporting year-end. Individuals file T1 tax returns based on a calendar year. Taxes are calculated, and tax returns are filed on a calendar year basis. Year-end is always December 31st. December 31st also applies to individuals who are self-employed. The CR categorizes self-employment income as business, professional, commission, farming, or fishing income. Corporations. The fiscal year is a corporation's reporting period. It is at most 12 months but can be shorter in a corporation's first year of operation. Can choose any date for the tax year end. Tax return must be filed within 6 months exactly from the corporation's tax year end date. Members of partnerships generally use the December 31st reporting year to report their share of partnership income or losses on the T1 return. Important tax reporting dates in the fiscal year in Canada. January 31st for most retailers. April 30th for most individuals. June 15th for self-employed individuals. October 31st for Canadian chartered banks. December 31st for Canadian life insurance companies and most corporations. Canada and the United States. In Canada, taxes are based on residency. In the U.S., taxes are based on citizenship. All U.S. citizens, regardless of where they live and the source of the income, are required to file a U.S. tax return. Many individuals live in one country but have income from another. Others may have dual citizenship or income from both countries. Tax treaties between Canada and U.S. reduce the possibility of double taxation on income earned. For example, Sam has lived and worked in Winnipeg for the past 20 years. He files his tax return every year before the tax filing deadline. Sam is also a U.S. citizen. Even though he has not worked in the U.S. for 20 years, he has to file a U.S. tax return to reporting the income earned in Canada. However, Sam can claim a tax credit on his U.S. tax return equivalent to income tax paid in Canada. The tax credit reduced the amount of U.S. income tax payable. 1.6. Types of income. A tax return has sections for total income, net income, and taxable income. Total income. Total income for each calendar year must be reported on a tax return, and includes employment and pension income, disability and child care benefits, EI, CPP, OAS, RRSP and DRIF withdrawals. Tax-exempt payments include inheritances, lottery winnings, strike pay, and life insurance death benefit. For example, last year Jackie won $3 million in the lottery and earned an interest rate of 20% when she invested it. The interest must be indicated on her tax return. Note, for an exhaustive list consult the General Income Tax and Benefit Guide on the CRA website. Net income. Net income is total income minus specific deductions. Net income begins with total income and lists the items, expenses and contributions that are deducted from it. Common deductions include RRSP or RPP contributions, child care expenses, and moving expenses. Required on provincial or territorial tax returns and is used for calculating child tax credit and GST, HST credit. Taxable income. Taxable income is net income after additional specific deductions. Specific additional deductions include Canadian Forces personnel and police deduction, employee home relocation load deduction, security options deduction, other payments deduction, limited partnership losses of other years, non-capital losses of other years, capital gains deduction, northern residence deduction, and additional deductions. Taxable income may be required on provincial or territorial tax form and is used for calculating federal tax. 1.7. Marginal and average tax rates. Marginal tax rates, MTR, is often described as the amount of taxes owing on each additional dollar of income. Tax rates are divided into tax brackets. As income increases, additional income is taxed at increasing rates. Marginal tax rate is the federal tax rate plus the provincial tax rate. Example. Margaret has taxable income of $80,000. The federal marginal tax rate for taxable income between $45,282, but not more than $90,563, is 20.5%. Margaret lives in Nova Scotia where the provincial marginal tax rate applicable on income amounts between $59,180 and $116,180 is 16.67%. So her combined marginal tax rate is 20.5% plus 16.67% or 37.17%. Average tax rate is the percentage of each dollar of income paid as tax. Average tax rate is tax paid divided by income earned. An individual's average tax rate will always be less than or equal to his or her marginal tax rate. Example, Kant. Margaret would pay $6,792 in federal tax on her first $45,282 of income and $7,117 on the remainder for a total of $13,909. In addition, she would pay provincial tax of $7,025 on her first $59,180 of income and $3,471 on the remaining $20,280 or taxable income for a total provincial tax of $10,495. So combined, her federal and provincial taxes will total $24,404. Dividing this amount by her $80,000 taxable income gives the average tax rate of 30.5%. 1.8. Deductions and credits. Deductions and credits are not the same, but both help to reduce the amount of tax an individual must pay. Deductions. Deductions reduce the income that is used for calculating taxes owing. One of the most common income tax deductions is the RRSP deduction, and every dollar contributed to an RRSP reduces net income accordingly. Credits. Federal and provincial tax credits reduce federal and provincial taxes owing. In other words, tax credits reduce tax payable. For example, up to $500 can be claimed for the children's fitness and children's arts amounts. The tax credit at the federal level is 15% of the claim. As a result, tax payable will be reduced by $75. Provinces also have a system of credits that reduce provincial tax. Refundable and non-refundable credits. Some credits are refundable. For example, GST, HST tax credit is a tax-free quarterly payment to low, modest income individuals or families. Most credits are non-refundable, meaning that they cannot reduce tax payable below zero, and if the credit cannot be used it will be lost. Some of the most common tax credits include Children's Fitness Tax Credit, Children's Art Tax Credit, Public Transit Tax Credit, and Tuition, Education and Textbook Tax Credit. 1.9. Tax reporting in the year of death of a person. When someone dies, a legal representative is responsible for administering the estate of the deceased. They include specific responsibilities pertaining to the CRA and Services Canada, such as provide CRA with the deceased's date of death, cease or transfer certain benefit payments, such as CPP, and filing tax returns and making sure taxes owing are paid. For up-to-date information regarding tax reporting in the year of death, consult the CRA online document, What to Do Following a Death. Rules that a legal representative must comply with following the death of a person. A legal representative is responsible for administering the deceased's estate and carrying out the distribution of the estate assets as stated in the deceased's will. The legal representative must provide the CRA with the date of death of the deceased, cease or transfer, in some cases, certain benefits the deceased was receiving. If someone dies between January 1st and October 31st, their final tax return is due on April 30th of the following year. If someone dies between November 1st and December 31st, the final tax return is due within 6 months of the date of death. If someone dies after December 31st but on or before the due date for the return, generally April 30th, the due date for filing the deceased's and the surviving spouse or common law spouse's return is 6 months after the date of death. If the deceased was self-employed or was married to a person who is self-employed, slightly different due dates apply. The tax return of the surviving spouse who lived with the deceased has the same filing dates as the deceased rather than the April 30th filing date. However, any tax owing must be paid by April 30th to avoid interest charges. The legal representative is responsible under the Income Tax Act for the following: filing all required returns for the deceased, making sure all taxes owing are paid, letting the beneficiaries know which, if any, of the amounts they receive from the estate are taxable, and obtaining a clearance certificate to certify that all amounts owing to the CRA have been paid. Any fees paid to the legal representative or the administrator are reported on a T4 slip, unless included in that person's business income. For up-to-date information regarding tax reporting in the year of death, consult the CRA website and online document, Preparing Returns for Deceased Person 2013. Definition of probate. Probate is the process through which a will is certified to be the deceased's last valid will and through which an estate's executor, in turn, receives approval from a court to obtain and distribute assets. Whether a will must go through probate depends on specifics and varies among provinces. Probate fees are administered based on the size of the estate, that is the fair market value, FMV, of the assets passing through the will. Probate fees vary considerably by province. Life insurance death benefits paid directly to a named beneficiary, that is the beneficiary is not the estate, are not subject to probate. Quebec does not require a notarial will to be probated. However, wills prepared by an attorney and witnessed must be probated. Estate taxation. A deceased individual's estate is taxed based on the principle of deemed disposition. In other words, for tax purposes, taxes are administered as if the individual had sold all his or her assets on the day of death at fair market value. 1.9.3.1 Spousal deferrals. An exception to this is the spousal rollover provision that permits assets to be transferred to the surviving spouse at the adjusted cost base of the deceased and obtained at the same tax cost. Under the spousal rollover provision, the deceased will not be taxed on the asset. Ownership will roll over to the surviving spouse. Only upon the death of the surviving spouse will the tax liability be assessed and become owing. The adjusted cost base, ACB, refers to the cost of an asset for tax purposes. It is generally equal to the sum of the purchase price, plus expenses incurred to make the purchase, plus expenses incurred to sell the asset less the sum of any capital distribution received. Example. Sid died with an RSP valued at $300,000. Under the CR rules, the RRSP can be transferred directly to an RRSP registered in the name of his wife Nancy with no tax consequences. Similarly, his stock portfolio can be transferred to her with no reporting of capital gains in such hands. In the case of the stock portfolio, Nancy's cost base is the contract's adjusted cost base, so any taxes on gains may be deferred until her death or until she actually disposes of the contract. 1.9.3.2 Rollover to dependent children or grandchildren. The fair market value of an RRSP is generally included in the deceased's income for the year of death. However, if an amount is paid from the RRSP to a financially dependent child or grandchild, the amount reported on the deceased's final return is reduced by that amount and T4 RRSP slips are issued to the child or grandchild who then report them as income. Financial dependence would require the child or grandchild to have income less than the personal amount. If the beneficiary is a dependent of the deceased due to mental or physical infirmity, the RRSP proceeds may be rolled, tax-free, into an RRSP or a Registered Disability Savings Plan, RDSP, in his name up to his available RDSP contribution room. Finally, a dependent child, or grandchild, under the age of 18 is entitled to a rollover of the RRSP refund of premiums to an annuity for which the child is the sole beneficiary. The annuity must be for a number of years not exceeding 18 minus the age of the child at the time of its acquisition. 1.10. Understand how individuals are taxed. Employers deduct federal and provincial tax from each employee's gross income and submit to CRA on behalf of the employee. The amount deducted is a credit against the employee's taxes otherwise payable. If due to the impact of deductions and tax credits, the tax otherwise payable turns out to be less than the amount deducted, the taxpayer will receive a refund when he or she files the tax return. Employers also deduct Canada Pension Plan, CPP, or, in Quebec, Quebec Pension Plan, UPP, contributions and employment insurance, EI, premiums and, in Quebec, Quebec Parental Insurance Plan premiums. Adjustments are made for employee contributions to RRSP, Registered Pension Plans, RPP, items such as retirement savings plan contributions, and taxable benefits including parking, cell phone and internet use. For up-to-date information on the Payroll Deductions Online Calculator, PDOC, payroll tables and TD1s, consult the CRA website. Working on commission, employment commissions. Salaried employees typically have very few options available for deductions related to employment expenses. Commission employees, as opposed to salaried employees, are usually entitled to more deductions such as those related to motor vehicle and home office expenses. Self-employed. Self-employed individuals can deduct business expenses such as insurance, interest, management and administration fees, maintenance and repairs, rent, property taxes, travel and fuel costs, professional fees, for example, legal or accounting services, salaries and wages, and business out-of-home costs. Example: Cho runs a painting business out of his apartment where he uses one room as a studio, which amounts to around 20% of his living space of his home. Therefore, he can deduct from his gross income 20% of his electricity, insurance, heat, maintenance, mortgage interest, property taxes and other expenses. If Cho purchases new painting tools or furniture for his studio, he can claim a deduction based on the type of asset. Special rules exist to determine the amounts which can be deducted each year based on the capital costs allowance class that the asset type falls under. Business owners. Owners of corporations can pay themselves in salary, or dividends, which may result in a more favorable tax treatment, or a combination of both. Example: Brenda's corporation had $50,000 of profits after tax last year. This money is now available to buy new equipment to expand the business. Had she been a sole proprietor, she would have had fewer funds after tax for expansion. Depending on which province the corporation operates in and assuming it is eligible for the small business deduction, it will have a tax rate between 11% and 23%. The rate in several provinces is 15.5%. Trusts. Trusts are legal structures which are also subject to taxation. Types of trusts include testamentary trust, created on the day a person dies. For example, Amos is a widower with 2 children ages 4 and 8. He changes his will to establish a testamentary trust with his children as beneficiaries and 2 of his brothers as trustees. Testamentary trusts are taxed federally using the same graduated tax rates as individuals. However, a budget proposal in February 2014 limited this to 36 months for estates, after which it will be subject to the top marginal rate. Graduated tax rates will continue for trusts whose beneficiaries are eligible for the disability tax credit. Inter vivos trust. Created during an individual's lifetime, taxed at the highest MTR at a rate of 29%. RRSP accounts and segregated funds are trusts held by a trustee, the institution that holds the assets, for the benefit of a beneficiary. REITs, real estate income trusts, hold real estate property for the benefit of unit holders. Mutual funds. Most mutual funds are trusts, few are structured as corporations. For up-to-date information on trusts, consult types of trusts on the CRA website. Understanding how income taxes can be deferred or avoided. Tax evasion is illegal. It can mean failing to report all income or making fictitious deductions. It is perfectly legal to avoid or defer some taxes, tax avoidance, through proper financial planning, using government-approved programs or choosing different types of investments to avoid or defer some taxes. Financial planning can be used to reduce taxes. TFSA, RRSP, and RESP accounts are government-approved programs that provide tax-sheltered investment growth. The use of these programs would thus result in lower taxes. Example 1. One wants to start saving for retirement. By using an RRSP, he lowers the amount of income tax he pays in the current year. His income within the plan grows tax-deferred, and he only has to pay tax when he withdraws funds or receives payments from a RIF or a registered annuity. Individuals can contribute up to 18% of the previous year's earned income to a maximum of $25,370 for 2016. Last year one had a salary income of $75,000. This amount constitutes one's total earned income. His contribution room for this year is 18% of $75,000 or $13,500. He decides to open a plan and contributes $13,500. He will be able to deduct that amount from his income when he completes his tax return for the current year. This will reduce his taxable income by $13,500. Some investments are taxed more favorably than others. For example, an individual can invest in equities to enjoy the preferential tax treatment of capital gains. Example 2. 5 years ago Janine bought shares in a technology company for $10,000. It has not paid dividends and is currently valued at $50,000. If Janine sells the shares now, she will pay tax this year on the taxable portion of her $40,000 capital gain, less transaction costs. Taxes can be deferred through the choice of investments. The tax an individual pays on interest, capital gains and dividends from Canadian public companies are different and vary by marginal tax rate and by province. Interest income is taxed in the year earned or accrued. Capital gains, however, are taxable on disposition. 1.11. When to refer to a tax expert. Life insurance agents should have a basic working level of taxation knowledge, but are not experts in all areas of taxation. There are many complex circumstances that require an advanced level of tax knowledge, where the agent should refer the client to a tax specialist such as a tax accountant, or a tax lawyer. Example: Alfred, Anthea, Roberto and Fatima are shareholders in a small advertising agency. Alfred is age 60, Anthea is age 40 while Roberto and Fatima are in their 30s. Their insurance agent recommends life insurance and disability insurance so that if one of the four should die or become disabled there will be funds available to buy out his or her interests. The agent has brought in the agency's accountants and a tax lawyer to advise on whether the insurance should be owned by the corporation or by the individuals. Chapter 2: Investment Income. Employment income is the primary source of total income for most individuals. However, if an individual has invested money in investment funds, buys and sells shares or property, they may receive investment income. 2.1. Taxation of investment income. Investment returns are taxed in different ways, depending on how the returns are generated. Interest, 100% inclusion, taxed the same as regular income. Capital gains, 50% inclusion rates, only half the capital gain is taxed. This is called the taxable capital gain. For example, If an individual has $1,000 in capital gains, only $500 is subject to taxation at the individual's MTR, and the other $500 is not. Dividends. Dividends from Canadian corporations enjoy preferential tax treatment via the dividend tax credit. If investment income is earned in a registered retirement savings plan, RRSP, a registered pension plan, RPP, or a deferred profit sharing plan, DPSP, all income is taxable including the capital invested, as the capital invested reduces the taxpayer's taxable income. If the investment is in a registered education savings plan, RESP, only the growth in the plan is fully taxable when the funds are withdrawn. This is because when the investment was made it would have been with after-tax dollars. Note that with registered plans the taxation of the income earned on the investment, the growth, is tax deferred until such time that it is withdrawn. Thus, the income does not have to be declared until it is withdrawn. Agents need to understand how investment income is taxed because it will help them develop insurance and investment strategies. Accrued interest. Interest income is fully taxable in the year that it is received. Some investments do not pay out the interest income manually but instead, let it accrue until maturity. Even though the interest income is not paid out, it is taxable annually, as though it had been paid, and must be reported. This is true for investments in all accounts except registered accounts, for which the taxation of income is tax deferred until it is withdrawn. At such time, the income plus the principal invested is fully taxable. Example. Madeline bought a $5,000 3-year Canada savings bond that compounds interest rather than paying it annually. She received a tax slip for the $50.15 in interest the bond accrued last year. She must report this amount even though she did not receive it. She will not pay tax on that amount when it is paid to her at the bond's maturity. This way, there will not be any double taxation. Dividend income from Canadian corporations. Dividend income from Canadian corporations is taxed at a lower rate than interest income. In other words, they get a preferential tax treatment. Dividends are paid out to shareholders from the after-tax profits of a corporation. The amount paid to the shareholder has already been taxed in the hands of the corporation. The shareholder then needs to pay tax on the dividend. This leads to a situation of double taxation because the government has already collected corporate taxes on the amount. To mitigate the situation, the government requires the taxpayer to report the gross-up amount of the dividend received. This is the taxable amount and reflects the amount of pre-tax income the corporation is presumed to have earned. The amount of the gross-up depends on whether the dividend is an eligible dividend, those received from public companies, or a non-eligible dividend, those received from private corporations. Dividends received from public companies or eligible companies are called eligible dividends. Eligible dividends received are grossed up by 38% to arrive at their taxable amount, and the federal government gives a dividend tax credit of 15.0198%. For non-eligible dividends, the gross-up rate is currently 18% and the federal dividend tax credit is 11.017%. Similar provincial tax credits are available for both eligible and non-eligible tax credits. The rates vary depending on the province. Example. Douglas received a T5 tax statement from the company whose shares he owned, indicating actual dividends received were $7,870. The taxable dividends were $10,860.60. The federal dividend tax credit was $1,631.24. Douglas wanted to confirm those figures. To do so, he multiplied $7,870 by 138% and got $10,860.60. He multiplied that by 15.0198% and got $1,631.24. Douglas's federal marginal tax rate is 22%. He calculates that he will pay $2,389.33 tax on the grossed-up taxable dividend, which when reduced by the $1,631.24 dividend tax credit will amount to $758.09. As a result, he has $7,111.91 after tax. Other types of dividends. In addition to the dividends discussed above, an agent may run into terms such as capital dividends and the capital dividend account, CDA. The CDA is a tax account which a private corporation uses to keep track of the tax-free amounts it receives. Amounts received such as the tax-free death benefit from a life insurance policy where the corporation has been named a beneficiary, less the policy's ACB, or non-taxable portion of capital gains are credited to the CDA. The corporation can then distribute the amounts in the CDA to shareholders as tax-free capital dividends. Example: Martina is president of a small corporation whose shares are owned by her children. The corporation is the beneficiary of a term insurance policy on her life. Martina dies and the proceeds of the policy are paid out to the corporation and applied to the capital dividend account. They are distributed tax-free to the shareholders. Dividend income from foreign source. Dividend income received from foreign sources does not receive the dividend tax credit. They are taxed the same way as interest income. Withholding taxes on foreign income. Investors who receive dividends from foreign corporations may have taxes withheld when paid. The amount of withholding tax depends on the foreign country. Tax treaties between Canada and most other countries help offset the tax liability on the dividend by way of a foreign tax credit, which credits the withholding tax already paid in the foreign country against the tax owing. As a result of these tax treaties, most countries waive withholding taxes on income paid from registered savings plans such as an RRSP or RIF. However, there is no mechanism for refunding withholding taxes pertaining to investments in a TFSA. Investors should consider the potential impact of withholding taxes on dividends paying foreign investments in their TFSA. Capital gains, disposition of capital assets. A capital gain occurs when an investor, individual or corporation, sells capital property at a price higher than its adjusted cost base, a CB, resulting in a capital gain for tax purposes. A sale of a capital property may also result in a capital loss if the property is sold for a value less than its ACB. Currently, 50% of capital gains are taxable, that is, capital gains have a 50% inclusion rate. Taxable capital gain is 50% of proceeds of disposition minus adjusted cost base. For example, if an investor purchases shares in a corporation for $5,000 and later sells those shares for $8,000, then the investor has a $3,000 capital gain and a taxable capital gain of only $1,500. If the investor was in a 30% MTR, the taxes owing on the $3,000 capital gain would be $450, 30% of the taxable capital gain of $1,500. Capital property is any property held outside of a registered account which the taxpayer invests with the view of making income. Capital property includes cottages, rental properties, building and equipment used in a business, stocks and bonds, mutual funds, segregated funds, etc., held outside a tax deferral account. Please note that a capital gain is triggered by a sale of the capital property. While the capital property is being held by the owner, no capital gain is triggered although the capital property might be appreciating in value. Accrued capital gains are not taxed annually. Only realized capital gain on the disposition of a capital property is subject to tax. Hence, investment in capital property may provide a means of tax deferral to an investor. A capital property need not be sold to trigger a capital gains tax. A deemed sale occurs if an individual exchanges one property for another, gifts a property, if the property is stolen or destroyed, a person immigrates from Canada, and upon the death of the property owner. Personal property. The disposition of personal property does not trigger a capital gain or loss. Personal property is a property owned by a person and used for his or her sole pleasure without intention of making any income on the property such as a boat or an automobile, household furniture, clothing, etc. The CR assumes that each of these properties has an ACB of $1,000 and holds that most personal property depreciates over time. Example: Andreas holds a garage sale to sell CDs, videos, clothing, toys and a table and chair set. She does not need to report her income from the garage sale. Listed personal property. The exceptions to this rule are listed as personal property and include prints, etchings, drawings, paintings, sculptures, or other works of art, jewelry, rare folios, manuscripts or books, stamps, coins. Net gains and losses on these must be reported on tax returns, although losses on listed personal property may only be deducted against gains from listed personal property. Rules pertaining to capital losses. Similarly, a capital loss occurs when an investor sells a capital property for a price less than its ACB. Example: If an investor purchases shares in a corporation for $5,000 and paid a commission of $150, the investor's ACB is therefore $5,150. The investor later sells those shares for $3,000, after commissions. The investor has a capital loss of $2,150. His allowable capital loss is $1,075. Capital losses also have a 50% inclusion rate. This portion is called the allowable capital loss. Offsets, carry-forwards, and carrybacks. Allowable capital losses must be applied against taxable capital gains for the current year, offsetting all or part of the gain. If loss still remains, it becomes the taxpayer's net capital loss, which is the difference between an allowable capital loss and taxable capital gain for that year. A taxpayer can carry back the net capital loss to reduce or eliminate capital gains in any of the 3 immediately prior tax years, or carry the loss forward into a future year. When carrying forward net capital losses from previous years to be used in a current year, the taxpayer needs to be cautious of the fact that the capital gains inclusion rate may have changed and thus would need to make an adjustment. In the Notice of Assessment, CR provides the adjusted net capital losses that are carried forward and which may be applied against capital gains in the current year. When carrying back net capital losses, no adjustments are needed. At death, capital losses may be applied against all sources of income of the deceased and not just to capital gains. Superficial losses. Active investors in the stock markets regularly review their trades for the year, and toward the end of the year they sell off some of their investments that are trading below their cost so they can use the losses to offset capital gains earned during the year, thereby reducing their taxes. In some cases, the investor may want to buy back the investments that were sold at a loss. If the investor buys back the investments that they sold for a loss immediately, the loss from the disposition will be deemed a superficial loss, and the investor will not be able to use the loss to offset capital gains for that year. A superficial loss occurs when an investor sells capital property at a loss, and the investor, or a person affiliated to the investor, buys or has the right to buy the same or identical property, called substituted property, within a 61-day time frame, from 30 days before the sale to 30 days after the sale, and the investor still owns or has a right to buy the substituted property 30 days after the sale. If the investor is the individual acquiring the substituted property, the investor can usually add the superficial loss amount to the ACB of the substituted property, thus, either reducing capital gains or increasing the capital loss when the substituted property is sold. Tax deferral. Because of the time value of money, it is quite often efficient to defer taxation as much as possible. A good example of this is the utilization of our RSP. Unlike accrued interest, which is taxed annually, increases or declines in the value of an investment, non-paper or unrealized gains and losses are not reported for tax purposes until the year in which the asset is actually sold or deemed sold. At the time of sale there is a realized or actual gain or loss. Example. An investor buys a stock for $10 in year 1, and it rises in value to $15 in year 2, and then it rises to $20 in year 3, at which point the investor sells it. In this case, there is no tax consequence in year 2, at which point there is an unrealized gain of $5, but there is a realized capital gain of $10 in year 3 which must be reported. Tax-free capital gains. There are exceptions to the taxation of capital gains. Some capital gains are tax-free. A notable example is the tax exemption given to capital gains on the individual's or family unit's principal residence. Tax-free gains on principal residence. Capital gains on a principal residence are tax-free in Canada. Only one principal residence can be owned at a time per family unit, which includes spouse and children under 18 years of age. The principal residence can include a house, condominium, cottage, houseboat, mobile home, trailer, and an apartment unit in an apartment building or duplex. Valuation Day Rules, 1982 changes and 1994 capital gains elections and implications. Prior to December 31, 1971, capital gains were not taxed in Canada. This changed after 1971. An adjusted cost base, a CB, for publicly traded shares was established using the fair market value as on December 22, 1971, and for other assets the ACB was the fair market value as on December 31, 1971. However, a principal residence would remain exempt from taxation. At that time, the principal residence exemption was given on a per individual basis. This meant that couples could own two principal residences and utilize the exemption, provided they were not jointly owned. This ended in 1982 when the rules changed to one principal residence at a time per family unit. As a result of the change, a couple could now only own one principal residence. Couples were advised to determine the fair market value of the homes as on December 31, 1981, to have a base against which to measure future gains. The rules changed again in 1994 when the federal government eliminated the lifetime capital gains exemption, LCGE, of $100,000. Many individuals with second residences applied any unused exemption to their second residences to raise the ACB. From an insurance perspective, many families who own a second residence and want to pass it on to their children and/or grandchildren use life insurance to pay the tax on taxable capital gains at death. Small business exemption and farm exemption. Starting in 2014 and indexed for inflation, each individual is entitled to a lifetime capital gains exemption of $824,176, which means a capital gains deduction of up to $412,088. Specific qualified capital property. O. Working farms. O. Qualified fishing property, and O. Shares of Canadian small business corporations, qualified small business corporations. Taxation of rental income. Rental income is taxable. Some of the costs associated with maintaining a rental property are tax deductible, such as legal, accounting and other professional fees, maintenance, upkeep and repairs, office expenses, insurance, and property taxes. If the rented space is within the taxpayer's home, certain expenses such as property tax would be limited to a reasonable percentage based on the number of rooms or square footage area rented out. Net rental income is considered earned income for the purpose of RRSP contributions. Exceptions: an adventure or concern in the nature of trade. The CRA's position is that if an individual does something that produces a profit on a regular basis, it is not considered a capital gain but income. The phrase the CRA uses is carrying on a trade or business even if these activities are separate from that person's normal occupation. The example given by the CRA is that if a dentist who habitually buys and sells real estate. In some circumstances, the rule can also apply to buying and selling securities. Example: Karen quit her job to become a day trader. Last year she had more than 500 trades. She had profits for some and losses for others. Overall she had a net profit of $125,000 after transaction costs. Because this is her full-time occupation, the CRA is likely to take the view that Karen is in an adventure or concern in the nature of trade and the $125,000 is business income, against which she can deduct office and similar expenses, and not capital gains. 2.2. Corporate structure and taxation. Many small businesses are structured as a corporation. When a business owner incorporates the business, it is a separate entity, legally and for tax purposes. Advantages of incorporation include lower tax rates for corporations than individuals, limited liability, ability to retain income in the corporation and invested by the corporation, opportunities for income splitting through a share structure. Disadvantages of incorporation include higher costs, legal, accounting, record keeping, increased regulation and overhead, flat tax rate. Unlike individuals who have a graduated tax rate structure, corporations have a flat tax rate. For a Canadian-controlled private corporation, the federal tax rate is 11%. Provincial tax rates range from 0 to 4.5%. Quebec's small business tax rate is 8%. Using a corporation to meet income splitting demands. Corporations can pay dividends from after-tax profits to their shareholders. The share structure of a corporation can be tailored to provide income splitting amongst shareholders. For example, a spouse within a lower marginal tax rate could subscribe to shares in a company run by the other spouse. Because the spouse is in a lower marginal tax rate, they would pay minimal tax on dividends received on the shares. Holding companies. An agent may have clients who have investment holding companies, with the holding company being used alongside an operating company and holding the shares of the operating company. Like with other corporations, this arrangement has cost implications in the form of filing financial statements and corporate tax returns. These costs can be significant relative to the income earned. These holding companies that were popular at one time due to tax deferrals are now falling out of favor due to changes in tax rates over the years. 2.3. Taxation of trusts. Mutual funds and segregated funds are structured as trusts and avoid taxation by flowing through all interest, capital gains, and dividends to unit holders, the investors that own the funds. The rule is that either the trust pays the tax on the income, or the income is flowed through to individual investors, who pay the tax. These funds flow through net interest income, eligible dividends, and foreign dividends to the investors. Mutual funds flow through net capital gains while segregated funds flow through capital gains and capital losses. The funds issue the relevant tax slips to investors. 2.4. Arm's length and non-arm's length transactions. Arm's length transactions occur between parties that are non-related while a non-arm's length transaction takes place between related parties. The Income Tax Act, ITA, states that related persons shall be deemed not to act at arm's length with each other regardless of how they conduct business. Related persons include parents, siblings, and relationships through marriage. The ITA also states that a corporation owned by a person will be related to another person including a corporation, in which the person has a controlling interest. Hence, a corporation will be related to a person if that O person controls the corporation. O person is a member of a related group that controls the corporation. O person is related to a person as described. This leads to various corporate dealings that would not be considered arm's length transactions. These definitions are important because special tax rules apply to transactions between related persons such as between spouses or between a corporation and its president. For example, an interest-free loan given by a corporation to its president will be considered a taxable benefit to the president. If the company charges the president the prescribed interest rate for the loan, no taxable benefit would arise. The prescribed interest rate for shareholders is published quarterly by CRA currently, it is around 1%. 2.5. Spousal and common law relations. Married couples and common law couples have property rights that vary from province to province. A province may consider that married spouses have equal interests in the family residence even if the residence is owned and was paid for by one of the spouses. The same may not apply to common law spouses. In contrast, in common law situations, that same province may hold that only the registered owner of the family home has the property rights. Rights on relationship breakdown. Property accumulated during the marriage or relationship will be divided equally among the divorcing and separating spouses, subject to any prenuptial or postnuptial agreement. Property acquired prior to the relationship generally remains with that person, as do any inheritances and insurance benefits received. Tax experts usually advise the couple on the most tax-efficient way to achieve the division of assets. Tax implications on relationship breakdown. The tax implications can be complicated, especially if it involves spousal support and child support payments. An agent should refer a client to tax and legal specialists to speak on these matters. Generally, spousal payments are tax-deductible to the payer and taxable as income to the recipient spouse. Payments for child support are not tax-deductible nor are they taxable. If equalization payments are required, a special transfer of RRSP, RIF or pension assets can be made using Form T-2220. Note that agents should refer a client to tax and legal specialists to speak on these matters. Tax implications on death. Assets owned by a deceased spouse generally can be transferred to the surviving spouse without tax implications. The surviving spouse will assume the deceased spouse's ACB for the transferred assets. The surviving spouse would be able to transfer the deceased spouse's RRSP or RIF as a tax-free refund of premiums to their RRSP or RIF, or by a registered annuity. Proceeds of a life insurance policy with the surviving spouse as a beneficiary will be received tax-free, as would any beneficiary. 2.6. Income attribution rules. Income splitting is a method of reducing overall taxes paid by a family unit by transferring income from a higher marginal tax rate family member to a family member that has a lower marginal tax rate. CRA has implemented income attribution rules to prevent income splitting between spouses and other family members. Where attribution rules apply for property given to a family member, the first-generation income earned on that property is attributed back and taxed in the hands of the giving family member. Any second-generation income earned on reinvested income, is taxed in the hands of the recipient income earner. Between spouses, the attribution rules pertain to zero-interest loans, transfers of property and gifts which could be used as an investment. Example: Ethel, whose federal marginal tax rate is 29%, lends $100,000 to her spouse Fred, whose federal marginal tax rate is 15%, to invest in the stock market. The loan is not documented, and no interest is charged. Under attribution rules, any income earned must be taxed as Ethel since she has the higher federal marginal tax rate. The attribution rules would not apply if Ethel were to lend funds to Fred to start up a business. In that case, any gains or losses would be Fred's. However, attribution rules will not apply if the spouse making the loan charges the other spouse interest at rates at least equal to the prescribed rates, and provided the interest is collected by January 30th each year and reported as income on the lender's tax return. Example: George lends his wife Loretta $100,000 for investment purposes. He charges her 1% interest, the CR prescribed rate at the time. He collects that interest and reports it on his tax return. Loretta must declare any interest, dividends or capital gains received from the investments on her tax return. Between parents and minor children and grandchildren, parents or grandparents can give monetary gifts to children, grandchildren, nieces and nephews. If these funds are invested, attribution rules apply, but in a manner different than that applicable to spouses. Any interest or dividends earned by the children are attributed back to the parents or grandparents. Capital gains or losses are not attributed back and are taxed in the hands of the child. Example: Irving buys $10,000 worth of bank shares and gifts them to his minor granddaughter Ellen. The shares pay about $400 in dividends each year. Irving is responsible for reporting the dividend as his income. Any capital gains triggered when the shares are sold are Ellen's and, therefore, are reported on her tax return. Between parents and adult children and grandchildren, any monetary gifts given to adult children or grandchildren by parents or grandparents are theirs and no attribution rules apply to gifts. However, if zero-interest loans are involved, attribution rules do apply to income splitting between adult children or grandchildren and parents, or grandparents. Again, charging an interest rate of at least the prescribed rates prevents the application of attribution rules. Tax treatment of income stemming from below-market loans to spouses. The exemption to the attribution rules is dependent on the loan to the spouse having interest charged at a commercial rate or the prescribed rate. The prescribed rate is tied to Treasury bill rates. The prescribed rate is currently 1%, but has been higher in the past and is subject to revision by CRA on a quarterly basis. Chapter 3, Taxation and Insurance. This chapter looks into the taxation conditions of life and disability insurance products, including annuities and segregated funds, within Canada in terms of death benefits, named beneficiary, premium, adjusted costs basis, life insurance policy dispositions, exempt and non-exempt policies, policy loans, corporate ownership of life and disability insurance, policy dividends, and specifics of annuities and segregated funds. 3.1. Death benefits. Life insurance benefits are tax-free. Example: Richard bought a $300,000 life insurance policy on his wife, Suzanne. Richard has only had this policy for a few years. Even if he dies tomorrow and has only paid a fraction of the policy's premiums, Suzanne will still receive $300,000 tax-free. If there is a delay in payment to a beneficiary and interest accrues, the interest, which is also payable to the beneficiary, is taxable, but the original death benefit is not taxable. Example: When Richard died overseas, there was a delay in obtaining the documentation required by the insurer. After it had been obtained, the insurer paid the death benefit, plus $945 in interest. Suzanne was required to report the $945 as interest income. The beneficiary can choose to take the death benefit in a lump sum in the form of either a lump sum, which ends the contract, or an annuity that results in a new contract. If there is a delay in the payment of the death benefit, any interest that accrues is taxable in the hands of the beneficiary or beneficiaries. Example: As a beneficiary of her husband's life insurance policy, Martha chose to take the death benefit as a life annuity rather than as a lump sum. She will be taxed on the interest portion of the annuity payments. 3.2. Named beneficiary. The owner of a life insurance policy can choose to designate anyone as a beneficiary. Probate is the process of validating the will. Probate fees are charged by the courts for undergoing the validation process. Probate fees vary by province. Life insurance proceeds paid directly to a named beneficiary stay outside the estate and are not governed by the will, and are therefore not subject to probate fees, such as the estate administrator tax. When the estate is named as the beneficiary, the proceeds will become a part of the deceased's estate and be distributed according to the will. As such, the proceeds will be subject to probate fees because it's a part of the deceased's estate assets. Example: Michael had substantial debts when he died and few assets. His named beneficiary was his wife, Renata. The insurer paid her the benefit. Michael's creditors, which included the Canada Revenue Agency, therefore had no claim on the amount paid. If Michael had named his estate as beneficiary, the insured amount would have been available to his creditors and subject to probate. 3.3. Premiums. Depending on the type of insurance, the premiums paid may or may not be tax deductible. In the sections that follow, we will discuss the taxation of premiums for each of the following types of policies: individual or group life insurance, individual or group health insurance, and individual or group disability insurance. Individual life insurance. Individual life insurance proceeds are generally not tax deductible. An exception is in a business context. If the insurance is required as collateral for a loan, then the premiums may be deductible. The loan must be with a chartered bank, trust company or credit union and documented. Only the lower amount of the actual premium that is attributable to the loan, the net cost of pure insurance, NCPI, can be deducted. Example 1. Jen bought a 10-year term policy and pays her premiums monthly. She cannot deduct her premiums from income for tax purposes. Example 2. Saul personally guarantees his business line of credit at the bank where he does business. His bank requires that he have life insurance equal to the line of credit, with the benefit assigned to the bank. The term policy issued to Saul has $1 million coverage. The loan amount Saul's business owed the bank last year averaged $400,000. Given that the loan is for business purposes and from a financial institution, he can deduct 40%, $400,000 divided by $1 million, of the lesser amount of the premium and NCPI as a business expense. Group life insurance. Proceeds are received tax-free, provided the employee pays the premiums with after-tax cash, or the employer pays the premiums that are then reported as a taxable benefit to the employee. Quebec is the exception where employer-paid premiums are taxable and must be reported on the provincial tax return of employees. Example: Lana's employer pays the premiums on the company's group life insurance policy and reports the amount of premium attributed to Lana as a taxable benefit on her T4 slip. Lana effectively pays the premiums from after-tax income, so the death benefit would be received tax-free. Group health insurance. Unlike group life premiums, group health premiums, such as a medical plan and dental plan, paid by the employer are tax deductible by the employer, and not a taxable benefit to the employee. Quebec is the exception where the premiums are taxable benefit and must be reported on the employee's provincial tax return and not the federal tax return. In all provinces, any portion of medical expenses that are prescribed, or eligible, under tax law and not covered by the policy can be claimed as medical expenses on that employee's tax return. Individual health insurance. Private health plan premiums can be claimed as eligible medical expenses. Example: Karen's employer does not offer group medical coverage. Consequently, she arranged her own coverage online. She can claim the premiums she pays as eligible medical expenses. Individual disability insurance. The premiums paid on private disability policies are not tax deductible. The benefits received are also not taxable. Example: Jonathan is self-employed. He applies for individual disability insurance coverage. He cannot deduct the premiums from income for tax purposes. Conversely, any benefits he receives will be tax-free. Group disability insurance. Group insurance contracts can include long-term disability, LTD, benefits, short-term disability, STD, benefits, or both LTD and STD benefits. Premiums may be paid by either the employee or employer. If the employee pays the premiums, it is done with after-tax income. The benefits are received tax-free and not reported on the tax return. This is the most preferred and most common structure for LTD plans. If the employer pays the premium is tax-deductible by the employer and not a taxable benefit to the employee. The benefits received are taxable in the hands of the employee. This is the most preferred and most common structure for STD plans. 3.4. Life insurance policy dispositions. Although life insurance proceeds are received tax-free, there are other transactions related to life insurance policies that can have tax consequences. There are several transactions that the Canada Revenue Agency, CRA, generally considers to be a disposition for tax purposes. Therefore, any gains in the following situations would be taxable: policy loans, partial withdrawals, surrenders, and transfers to another party. Note that the Income Tax Act provides for an exception such that transfers between spouses have no tax consequences. A taxable policy gain is calculated as follows. Taxable policy gain is proceeds of disposition or cash surrender value minus adjusted cost base. Example. Sandra decides to surrender her policy. It has a cash surrender value of $13,500 and an adjusted cost basis of $8,000. Sandra will report taxable income of $5,500 calculated as $13,500 minus $8,000. Adjusted cost base. For tax purposes, the adjusted cost base, ACB, is the cost of a life insurance policy. Insurance companies will typically provide the ACB to the policyholder if required or requested. Very important for agents to know what affects the ACB and how to calculate the ACB. How the ACB is calculated depends on when the policy was last acquired. The rules regarding the ACB calculation changed in 1982, and the old rules still apply to policies that have been last acquired before the change. For policies last acquired after December 1, 1982, the ACB is calculated as follows. Adjusted cost base, ACB, is premiums paid minus NCPI. For grandfathered policies issued prior to December 2, 1982, the entire premium is considered to be the ACB. Adjusted cost base, ACB, is premium paid. 3.5. Exempt or non-exempt life insurance policies. Permanent policies may be either exempt or non-exempt. Term policies have no CSV and, therefore, the distinction between exempt and non-exempt does not apply to term policies. The rules pertaining to exempt and non-exempt policies will change after 2015. Exempt. If a life insurance policy is exempt, the earnings on the cash value in the policy are not subject to taxation in the hands of the policyholder. Permanent life insurance policies acquired prior to December 2, 1982, are always exempt. If the policy is sold, then the exemption no longer applies. Policies acquired after December 1, 1982, are exempt if they are purchased for the sole purpose of providing insurance and not as a means of investment. Non-exempt. A non-exempt policy is one that is last acquired after December 1, 1982, but fails to meet the Income Tax Act exemption requirements. For additional information on the Income Tax Act, consult the Justice Law's website. Upon failing to meet the exemption requirements, earnings are taxable, annually, as regular income in the hands of the policyholder. On the policy's anniversary, the insurance company must conduct an exemption test. Recall from the previous section that, a policy is considered exempt if the sole purpose of the death benefit is strictly for insurance purposes and not as a means of investment. Tax rules are changing, and are expected to change in 2015, regarding exempt and non-exempt policies. This flex has a great impact on life insurance policies. Term policies did not have a cash surrender value, CSV, and as such the distinction between exempt and non-exempt does not apply to term policies. Universal life policies. When the cash accumulation limits permitted by tax laws are exceeded due to investment growth, the insurer transfers the excess funds to a side account in order for the policy to remain exempt. Only the income earned in the side account will be taxable. 3.6. Policy loans. If an insurance policy has a CSV, the policyholder can borrow up to the full amount of the CSV from the policy. This is known as a policy loan and can only be done if the policy allows for policy loans. Amounts up to the ACB can be borrowed tax-free. Amounts borrowed in excess of the ACB are taxable, and When the loan is repaid, the policyholder can claim a tax deduction up to the amount that was previously reported as income. Example: Mario needs money for a home renovation. His insurance agent tells him he can borrow up to $9,000 from his policy, the CSV, but he will have to declare $4,000 as income because his ACB is $5,000. Mario borrows the money, and when he repays it the following year, he deducts the $4,000 from his taxable income. 3.7. Corporate ownership of life and disability insurance. Corporations often purchase insurance on key executives and employees. Benefits received from these policies are tax-free. Premiums are usually not deducted from income. If the employee dies, the corporation receives the death benefit. Tax implications of a person buying back a corporate policy. If a corporation has life insurance on an employee, and the corporation sells or gifts the policy to the employee upon retirement, any policy gain will be taxable to the corporation. This applies only to permanent policies. Term policies have no CSV and, therefore, there would never be an associated policy gain nor any taxable consequences. Example: when Yvette was hired by her employer 5 years ago, the company purchased a 10-year term policy on her life. The company is merging with another and Yvette's position is now redundant. As part of her severance package, the company is assigning her the term policy. There is no policy gain for the company on the transfer of this term policy to Yvette. Expert advice should be sought when there is a taxable benefit to the employee. Tax strategy based on differential between corporate and personal tax rates. In cases where the corporation is the beneficiary of the policy, if the insured dies, the corporation receives the benefit. Corporations benefit from a lower tax than shareholders. Therefore, it is advantageous, for the corporation, rather than the shareholder, to buy the life insurance policy. Example: Bert has a combined federal and provincial marginal tax rate of 49.5%. The corporation he and his wife own has a combined federal and provincial marginal tax rate of 15.5%. Bert is not an employee of the firm. The premiums paid on a life insurance policy on Bert would not be deductible, either by the corporation or by Bert. Consequently, there are savings by having the corporation with its lower tax rate pay the premium. When Bert dies, the proceeds of the policy will flow through the company's capital dividend account, CDA, to the shareholders on a tax-free basis. To pay a $10,000 annual premium, the company would only have to access $11,834 of corporate profits, while Bert would have to be paid $19,802 out of company profits to have the necessary $10,000 after tax to pay the premium. Capital Dividend Account, CDA. The Capital Dividend Account, CDA, is where a corporation receives and holds any tax-free amounts, such as life insurance proceeds. Any amount in the CDA can be paid out as tax-free capital dividends to shareholders. Tax treatments of the benefit when the insured is an employee, shareholder, or both. Corporations frequently pay disability and life insurance policy premiums for the employee or shareholder. The shareholder or employer would be the holder of the policy, the beneficiary, or both. Premiums paid by a corporation are tax deductible by the employer and a taxable benefit for the employee, and not tax deductible by the employer and taxable to the shareholder. Example: Louise is employed as a financial controller for a corporation. She also owns 15% of the company's shares. Because of her ownership position, any premiums paid on her behalf are not deductible and are added as a taxable benefit. Consequently, she pays the premiums on her life insurance policy directly. 3.8. Policy dividends. Permanent whole life policies may pay dividends to policyholders. Note that policy dividends are not the same as corporate dividends. Policy dividends are tax-free when used to offset premiums or paid out as a death benefit. When policy dividends are paid out prior to death, they are taxable as income as they are considered to be proceeds of disposition. They are not entitled to the dividend tax credit, as is the case with capital dividends. If the amount of the dividend exceeds the ACB in any given year, the excess would be treated as a disposition of the policy gain and is taxable in the hands of the policyholder. 3.9. Annuities and segregated funds. A wide range of annuities are offered by insurance companies such as the individual variable insurance contracts, IVIC. IVICs are also referred to as annuity contracts and hold segregated funds. The taxation of the following annuities are explained in the sections below. Non-registered annuities contracts. Non-registered individual variable insurance contracts, IVICs, and registered contracts. Non-registered annuities contracts. Non-registered annuity contracts are taxable. How they are taxed depends on the structure and the type of income being paid. Both segregated funds and annuities may be registered or non-registered. For non-registered annuities, a portion of the payments is received tax-free as a return of capital, and a portion is received as interest income and is thus taxable. For registered annuities, all payments are fully taxable as regular income. Accumulation annuities or guaranteed interest annuities. Accumulation annuities or guaranteed interest annuities are savings products similar to guaranteed investment certificates, GIC, and term deposits offered by banks. They offer creditor protection and avoid probate when a beneficiary is named. Interest earned is taxable in the year received or accrued, even if not received. Prescribed annuities. Prescribed annuities offer a special tax advantage. The interest, taxable, and return of capital, non-taxable, portions are spread equally across all of the payments. With a non-prescribed annuity, the payments the holder receives would be more interest than principal in the early years of the term to maturity and less interest than principal near the end of the term. For two identical annuities, one qualifying as prescribed and the other one not, the total amounts of interest reported over the life of the annuity would be identical. What differs is that the holder of the prescribed annuity would report less taxable income in the early years and consequently pay less tax. Example. Lola has an inheritance of $100,000 and wants annual annuity payments for 20 years. Annuity interest rates for the term are currently 3.15%. Her agent tells her the annual payment on a 20-year prescribed annuity with a $100,000 deposit will be about $6,800, $1,800 of which is taxable. The interest that would accrue for the first year on a non-prescribed annuity would be $3,150 or 3.15% of $100,000. It would drop to approximately $1,800 by the 11th year. Lola chooses the prescribed annuity and understands that the taxable portion each year will be a level $1,800 as shown in the graph in section 3.9. Had she chosen the alternative non-prescribed annuity, the taxable portion in the first year would be $3,150, declining each year after that. Lola decides that it is to her advantage to pay less tax now. For additional information on prescribed annuities, consult the online document, Taxation of Non-Registered Prescribed Annuity Contract from Manulife. Structured Settlement Annuities. A structured settlement annuity is an annuity purchased by a casualty insurer as a settlement of a personal injury lawsuit. The lump sum is paid to the insurance company, who then issues a single premium annuity and makes the tax-free payments to the injured party. Example. Rudolph became a paraplegic after a vehicle ran a red light and hit him. The driver's insurer and Rudolph's lawyers have agreed on a settlement. The casualty insurer will purchase the annuity that will be paid to Rudolph tax-free. Non-registered individual variable insurance contracts, IVIC, holding segregated funds. Switching between segregated funds triggers a disposition which can create capital gains or losses. Unlike mutual funds, segregated funds did not distribute investment earnings to policyholders. The income is retained in the fund and the policyholder's ACB is adjusted to reflect the retained earnings. The policyholder is still taxed on the earnings as though they had been paid out and received. Interest, dividends, or capital gains must be reported on the T3 slip by the insurer. Dividend, interest, and capital gains distributions. Unlike mutual funds, investors of segregated funds receive prorated investment returns. Returns are prorated based on the time an investor holds the units in the fund during the year. Example. Massimo bought 1,000 units of XYZ segregated equity fund on June 1. The fund declared a dividend distribution of $1 a unit at year-end. Massimo's T3 will show an allocation of $583.33, reflecting that he owned the units for 7 of the 12 months. $583.33 equals 7 divided by 12 times $1 times 1,000 units. On the other hand, the income earned through mutual funds is not prorated based on time held. Example. Had Massimo bought a comparable mutual fund, His T3 from the fund would show a $1,000 distribution whether he bought it on January 1st, June 1st, or the day before the distribution was declared. Treatment of capital losses. Any capital losses in a segregated fund flow through to the contract holder and are reported on the contract holder's T3. This is unlike mutual funds where capital losses are used to offset capital gains within the fund. Capital losses not used in the present year can be carried forward or applied to losses in the past 3 years. Tax treatment of death benefit or maturity guarantee. Segregated funds typically provide a guaranteed amount at maturity, generally 10 years, or at death. The contract holder is guaranteed a minimum of 75% or 100% of the amount invested in the contract. The tax treatment of any amounts received as a part of either a maturity benefit or death benefit is ambiguous and unclear. The segregated fund information folder contains the position of the insurer regarding tax treatment. Taxation of registered contracts. There is no tax on income earned, for example, in terms of interest, capital gains and dividends, in registered retirement savings plans, RRSPs, registered retirement income funds, RIFs, or other registered contracts. When money is withdrawn from these products, all funds are treated as taxable income. Regarding registered education savings plans, RESP, there are no tax consequences regarding the withdrawals of RESP contributions that were made with after-tax income. All income earned when withdrawn is taxable. Chapter 4, Tax Strategies Using Life Insurance. This chapter examines tax strategies that are implemented using life insurance. These strategies are examined within 4 principal components. Life insurance strategies used to offset or likely reduce taxes payable at death. Taxable investment strategies implementing life insurance products for tax benefits. Leveraging strategies and borrowing in terms of deductible income, and donation program tax shelters. 4.1. Estate planning. For tax purposes, a person is considered to have sold all assets at fair value on the date of death for proceeds equal to the fair market value. This is known as a deemed disposition of assets. For someone who is married, or common law, there are some exceptions to the deemed disposition and subsequent taxation of assets at death. Certain assets such as an RRSP can be rolled over to a surviving spouse without triggering a taxable event. Under the Income Tax Act, the taxation of the asset would be deferred until the funds are withdrawn or upon the death of the surviving spouse. This tax deferral provision is known as a spousal rollover. Capital gains. Life insurance can be a great tool for providing funds necessary to cover tax liabilities that arise upon death, particularly when the objective is to maintain ownership of the asset within the family for the benefit of survivors. Example 1. Ralph and Melinda own a cottage that will be left to their daughter Martha, as stated in their wills. They purchased the cottage several decades ago and estimate that the tax on the taxable capital gain on the property will be around $100,000. They purchased a second to die $100,000 permanent life insurance policy to provide this amount so the estate will have the funds to pay the tax. Example 2. 3 brothers own equal shares in a successful landscaping company. They have an agreement in place whereby, if one of the brothers should die, the surviving brothers will purchase the shares from the estate of the deceased. Their insurance agent arranges for each to buy insurance on the other's lives in amounts adequate to buy the shares. Income tax payable on the death of a registered plan owner. An individual's largest financial asset is often a registered retirement income fund, RRIF. The fair market value of the RIF at the time of death is taxable as income in that year. Life insurance is often used to pay taxes owing from the RIF, thus leaving the beneficiaries with the full value of the RIF. Example. Ethel, who is a widow, turned 71 last year and rolled her $500,000 registered retirement savings plan, RRSP, into a RIF at year-end. Ethel wants to leave an estate for her children. Her major asset is her RIF. She recognizes that when she dies the market value of her RIF will be income for tax purposes and a major portion of its value will be payable as income tax. She also realizes that if she lives a long time, there will be very little value left in her RIF to provide an estate. If the value of her RIF was $500,000 at the time of death, all of it would be considered as income and, depending on her other income at the time of death, most if not all would be taxable income. Depending on the province in which she resides at the time of death, the tax owing could be as much as $249,000. Ethel's insurance agent determines that she can obtain $250,000 of term to 100 insurance at an annual premium of $9,540. This will provide the funds required to pay the substantial taxes that will be owed after her death if she dies in the next few years. If there is little residual value in her if when she dies, then the insurance proceeds will provide funds for her children. Ethel, therefore, decides to apply for $250,000 to cover the potential tax bill, and funeral and other final expenses. Ethel decides that a life insurance policy will meet her specific need to insure an estate for her beneficiaries. Estate taxes and probate fees. There are no estate taxes in Canada when a taxpayer dies. However, the deceased may face U.S. estate taxes if any property was owned in the U.S. In such cases, it is advisable to work with taxation experts knowledgeable about U.S. tax law to determine U.S. taxes owing, if any. Probate fees apply to mutual funds and savings instruments, outside of Quebec. Probate fees do not apply to life insurance death benefits when beneficiaries are named. Insurance company investment products, that is annuities and segregated funds. 4.2. Leveraging to make an investment. Leverage is the term used to describe borrowing money for the purpose of investment. The concept is to increase investors' equity and thus profit above what it would be without the use of the borrowed funds. Both investors and agents should know that the investors are responsible for repaying the interest on the loan as well as repaying the principal if the value of the investment diminishes. Interest on the loan is tax deductible. However, if the borrowed funds are used to contribute to an RRSP, then the interest is not tax deductible. Agents should be familiar with leverage guidelines provided by the insurers whose products they sell, and the mutual fund dealers' guidelines pertaining to leverage, if licensed to sell mutual funds. Many insurers and mutual fund dealers place restrictions on using leverage programs for people who are near or in retirement. Borrowing to contribute to a registered retirement savings plan, RRSP. One strategy for clients who do not have the cash to make an RRSP contribution is to borrow a portion, or all the funds necessary to make that contribution. This strategy is usually implemented during the first 60 days of the calendar year prior to the RRSP contribution deadline. The loan would be repaid by using the tax refund stemming from the contribution or from take-home earned income over the year. With this strategy, the interest paid on the borrowed funds is not tax deductible. Borrowing to buy a non-registered investment. When a loan is taken out for investment purposes, the interest paid on that loan is generally tax deductible when the investment is made in a non-registered account, provided the investments have the potential to generate income. Opening margin accounts with investment dealers is a strategy often used by investors to borrow against equity in their accounts with set limits in place. The ratio of debt to equity must stay within defined limits. A decrease in the value of the equity, the investments, will require the borrower to put up additional capital or sell enough assets to generate cash in the account to maintain the required ratio. Interest on margin loans is also tax deductible provided the loan is used to buy additional investments. Some agents recommend that their clients borrow money to buy segregated funds in rising markets. Leveraging can make sense when the anticipated return on investment is greater than the cost of borrowing. For example, a loan at 3% and investment returns of 8%. Example. Madeline paid $500 interest on her investment loan. Her marginal tax rate is 46%. Consequently, she deducts this amount as a business expense, reducing the tax payable by 46% times $500 equals $230. The after-tax cost is $270 calculated as $500 minus $230. Agents should resolve whether or not a leveraged investment strategy is appropriate for a particular client's needs. The appropriateness of such a strategy should be determined on an individual case-by-case basis in terms of the apparent risks involved, and the cyclical and sometimes volatile nature of the market. Factors that should be considered when determining suitability are: does the client have the cash flow available to service the debt for an extended period of time if the investment declines? Is the client's tax bracket beneficial in terms of interest deductibility? What is the client's tolerance for risk? Agents need to keep in mind that in the past interest rates have been higher than in the present. And while interest rates may be currently low, they can become higher in future years. Higher interest rates can altogether lessen or defeat the benefits of implementing a leverage strategy for the client. Ideally, investors should have accessible income to pay the interest or cover a potential margin call. Also, when borrowing to invest in segregated funds, agents should know that redeeming segregated fund units to pay interest lowers the maturity guarantee. 4.3. Using insurance products for long-term income. Prescribed annuities can provide for long-term income and are beneficial from a tax perspective because the original capital and interest are spread over fixed payments. An insured annuity is a combination of two products, life insurance and a life annuity. For risk-averse investors, this is often an alternative solution to guaranteed investment certificates, GICs. The prescribed annuity provides tax-advantaged income, and the life insurance provides a death benefit upon death. Example. Fred, who is 70, recently sold his home and business and has $500,000 available for investment. He is unwilling to risk his capital and wants to leave that amount to his children. He is aware that he can earn 2.5% by purchasing a 5-year GIC, which will provide him with a $12,500 annual income, all of which will be taxable. Fred's insurance agent suggested an alternative. He recommended that Fred apply for $500,000 of term to 100 life insurance, which will cost him $20,652 a year. Once that is approved, Fred can buy a prescribed life annuity for $500,000, which will provide him with annual income of $38,440 with the taxable portion at $1,562. The annuity payment less the cost of the insurance will leave him an income of $17,788 calculated as $38,440 minus $20,652, which far exceeds the $12,500 income from the GIC. Moreover, only $1,526 of the annuity income is taxable compared with all of the $12,500 GIC income. Fred's major risk is that interest rates will rise in the coming years and he will not benefit from any rate increase. 4.4. Charitable donations. Registered charities often seek out insurance policy donations from their supporters. Donors to registered charities receive a federal and provincial charitable donations tax credit. The donor would be the life insured, and the organization would be the owner and beneficiary of the policy. As long as the premiums continue to be paid, the organization will receive the death benefit upon the death of the life insured. For the donor, the federal charitable tax credit is 15% on the first $200 and 29% on any amounts more than $200. The provincial tax credit rates differ in each province. These tax credits are non-refundable. Quebec residents may experience reduced tax savings when individuals are entitled to a refundable federal tax abatement. An individual may claim a tax credit for a donation up to 75% of net income. The donation limit is 100% of the net income in the year of death. Any unused amount can be carried back to the year prior to the year of death. The donation limit would be up to 100% of income in that year. Assigning a new insurance policy to a charity. A common strategy is to purchase a life insurance policy to provide a charitable donation to a registered charity upon death. To be entitled to the charitable tax credit, for the premiums paid on the life insurance policy, the policy must be assigned so that the charity is the owner and the beneficiary of the life insurance policy. Example. Rivka has been donating $500 annually to the alumni fund of the university she attended and receives a tax credit receipt for that amount each year. A representative of the university suggested that she consider buying a life insurance policy and assigning it to the university. She agreed and purchased a Term 100 life policy with an annual premium of $500 and a face amount of $50,000. She assigns the policy to the university and continues to pay the premium, for which the university issues a charitable donations tax credit receipt equal to the premium. Assuming Rivka does not let the policy lapse, the insurance company will pay $50,000 to the university when she dies. Assigning an existing policy to a charity. Another common strategy is to donate an existing policy to a registered charity. In such cases, the charity will issue a charitable donation tax credit receipt for the cash surrender value, CSV, of the policy. Additional tax receipts will be issued any additional premiums paid by the donor. Note that if the policy CSV exceeds the policy's adjusted cost basis, ACB, the policy gain will be taxable as income in the year the policy was donated to the registered charity. Example. Lars has a permanent life insurance policy he no longer needs. The market value of the policy is $12,000. He calls the fundraising office at his local hospital and speaks with the director, who informs him that if he assigns the policy to the hospital, he will receive a tax credit receipt for the market value. Furthermore, if he continues to pay the premiums, he will receive tax credit receipts for these. Naming a charity as beneficiary. Another, less effective, strategy is for the life insurance policyholder to name a charity as the beneficiary of a policy. This is not as tax efficient, as the charity does not own the policy and, therefore, cannot issue receipts for the CSV or premiums paid. However, the charity will issue a donation receipt for the death benefit received to the deceased's estate. Example. For example, Rosalind reviewed her finances and decided that she no longer needed the benefit from an insurance policy she had purchased decades earlier. She called the issuer, who sent her a change of beneficiary form that she completed, changing the beneficiary to a local animal shelter that is a registered charity. If she continues to pay the premiums to keep the policy in effect and does not change the beneficiary, when she dies, the animal shelter will issue a charitable donation tax receipt to Rosalind's estate for the amount of the benefit it receives. Because the charity did not own the policy, it could not issue charitable donation tax credit receipts for any of the premiums she paid. Donating a segregated fund contract. Special rules apply when publicly traded securities and insurance contracts holding segregated funds are donated to a registered charity. In normal circumstances, upon the disposition of a security, 50% of a capital gain is taxable. However, when securities or segregated funds are donated to a registered charity, the capital gain inclusion rate is reduced to 0 so that none of the capital gain is taxable. Example. Jack redeems $100,000 of segregated funds that have an ACB of $50,000. He donates the money to a registered charity and receives a charitable tax credit receipt for $100,000. He pays tax on half his capital gains, or $25,000. Jill, on the other hand, donates her $100,000 of segregated funds contract to a registered charity. While her ACB is also $50,000, her capital gains inclusion rate for the donation is 0, so she pays no tax on the capital gain and receives a charitable tax credit receipt for $100,000. For more information on segregated funds, consult the Manulife Financial page, Charitable Giving. Donation Program Tax Shelters. Donation program tax shelters are tax shelters and donation plans that offer unusually higher returns, tax refunds, or tax reductions in excess of the amount actually invested. The following is an example of what a tax shelter arrangement involving a charitable donation receipt look like. A promoter sells a tax shelter-like arrangement to individual taxpayers involving 10,000 pieces of art. Each taxpayer acquires one piece of art for its fair market value of $100. The valuator is aware of this information but agrees to appraise each art piece at $1,000. Concurrently, the promoter solicits a registered charity that agrees to accept the art as a charitable donation and issue a charitable donation receipt of the appraised value, $1,000 per art piece. This charity immediately auctions off the art to the highest bidder, and the price paid reflects the $100 value per piece. A tax return preparer, who does not have any direct knowledge of the false statement, prepares the income tax return of his client. The CR conducts a review of the client's return and determines that it contains a false statement, the overvaluation of the property donated. Since the 1990s, the Canada Revenue Agency, CRA, has continuously issued warnings about donation program tax shelters. In almost all cases, the tax donation credit issued for the donation will be disallowed by the CRA. Advisors should proceed with a high degree of caution, as many of these such programs are offside with the CRA and could lead to trouble for both the advisor and the client. Agents should review the CRA documents on gifting tax shelter schemes. In particular, the CR publication, Canada Revenue Agency. Tax Shelters. Revised December 12, 2013. Cited August 1, 2014. States that the CRA audits every gifting tax shelter scheme and not a single arrangement has been found to comply with the Income Tax Act. Agents need to know their employer policies and consequences regarding participation in these prohibited activities.